Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracey Ryniec, and this week I'm going solo to talk about some of these stocks that have plunged down here in February of 2025. Are there any deals, or are they traps, even though they've sold off? I'm going to take a look at 5 hot names. These were big winners through 2024 at least. And some of them have really taken a dive here. Some, it's just been more recent here in February of 2025, but they're all off their all-time highs, so to speak, which has happened in the last couple of months for most of them. So what is going on out there? We have seen a pullback in the markets, and you know what that means. There could be some stocks on sale and an opportunity. So I just took a look at a bunch of the hot names. We know who they are. And these are companies that have already reported, because I wanted to take a look and see, is there a reason these are selling off in addition to just the overall market sell-off? Or that maybe they just were a little bit too speculative and stretched, so they were due for a pullback. Is something going on with the earnings as well? And that might be a warning for you to stay away. So let's take a look at 5 of these names. You will know them. A couple of the other hot names I had to stay away from because they have yet to report when I'm recording this. So for those of you who are listening, I will try to describe what I see in terms of the charts and what is going on with these earnings and the Zacks rank as well on all of these, because we will look at the rank right here to see if maybe the analysts are cutting those earnings estimates going forward. Also, I wanted to just put a little side note in about a podcast I did a couple of weeks ago with Nina Mishra, our ETF director of ETF research here at Zacks, on gold. I see that not many of you cared about it. So I also find that interesting. These hot stocks are the names everybody wants to be in. You've been loading up on these, and yet gold continues to hit all-time highs. And so this might be a time to want to be in gold, but none of you really want to be. So go check out that podcast I did. It was just on how to invest in gold right now. And we covered ETFs. We covered some individual stocks. We covered the ETFs that own the physical gold. You can also, buy some jewelry or things with gold in it. But we cover the easier ways of buying gold on that podcast. So go check that one out. It was put out in February 2025, and you can find it on YouTube at zacks.com/YouTube. Go to YouTube. Okay, back to these 5 stocks. We're going to start with one of the hot restaurant stocks. These are like all the stocks I've called like beasts in the past because they're charts were just incredible. Their growth was incredible. Some of it was pandemic caused, but then they kept the momentum. Others, it was just kind of getting their act together once the supply chain fixed itself. Some are in tech, so we know kind of what's going on there with the AI story. But let's dive in first on the restaurant side. Okay, I chose Wingstop, ticker WING. It's been red hot, but now it's not. You can see if you're watching the video, it's got a Zacks rank of 4. Remember, all these companies have already reported earnings. So I'm assuming there have been some estimate cuts, and we're going to check that out in a moment. It still has the A for growth. It's got a C for momentum on the style scores. It has the F for value, but it hasn't been a value stock for many years as the shares just took off. Yes, earnings did rise too, but it's just been a little too pricey to ever be considered a value stock. And now it has a D score of the style scores. So this is all kind of on the negative for Wingstop. And just scrolling down, you can see right away on the price consensus and surprise, they did beat this last quarter, but the shares continue to be weak. 1 month, they're down 14.8% over the last 6 months, however, and you can see the big decline on this chart over the last 6 months, down 41% from those 2024 highs. But look at this price to consensus line, the 2025 and the 2026, they are both on the decline here. So the analysts last year were much more bullish on what was going to go on at Wingstop than they are here in 2025, and they are likely cutting these estimates, but we are going to look in just a moment. But I scroll down, I see the forward P is still at 63 times. So that's why you got that F for the value. Most likely, it's still, the valuations are still just too high, even though it's down sharply. Okay, I'm in the detailed earnings estimates and I'm scrolling down. We still have excellent revenue growth, 17% expected for 2025, another 17 for 2026. That's all fantastic, but look at 2025 now on earnings growth, just 1.9%. They made 366 last year, expected to make 373. So the growth on the earnings side, coming to that halt very quickly. So you can see this is how the Zacks rank can help you and how it can, predict where a stock may see some share weakness, because while a lot of this is probably happening now, yes, you can see in the last 7 days, 9 estimates have been cut. Nobody is raised for 2025, and then another 4 cut for 2026, although 1 has raised. It is expected to rebound 29% by next year, but all of the iffiness is being priced into this year. That could mean commodity prices rising. They have to raise prices. The consumer might be pushing back on some of that. I was just at the Wingstop and someone came in with an order for like a family thing, and it was like $60. And I thought, wow, that's a lot for dinner for your takeout food. So they could be seeing some pushback on that as well, even though wings remain popular. And again, a lot goes into the cost of the wings, obviously, for a company like Wingstop. And over the years, there have been spikes in wing prices, and then they've come back down. That helps the margins. So these are all things to watch with Wingstop. Is this a deal here, or is it more trappiness? Now, when we're looking at value stocks and we're looking at deals versus traps, we do look to see what's happening with the earnings and whether or not that is going to see an earnings decline or a sharp pullback in those earnings. That is what we're seeing here. There's not really a deal as far as valuation, but if there was still the growth there, and there is on the sales side, then I'm a little more interested. But momentum is really to the downside here. You can see just right here on this price and EPS surprise chart, this is only the 3-month, the big sharp decline on those earnings, and the shares continue to be weak here. I'm not sure if it's found the bottom yet here. So I would still be on the sidelines given the 41% pullback over the last 6 months. And we may continue to see a little bit more of a pullback here and a better entry point. So I'm not sure this is a deal here, not quite yet, but I'm keeping it in my watch list, even as a value investor, because I still love this business, even if it slows down a bit, but I need it to get a little cheaper yet. I'm greedy. I like to get it cheap, even on these growth names. So that's Wingstop, ticker WING. Okay, we're going to switch over to technology, one of the hottest stocks on the street, Palantir. A lot of complaints about it, especially from value investors, as it just keeps going up and up and up. But over the last just 5 days since I recording this on February 25th, it's down 29% in that period on worries about cuts to government contracts. It gets a lot of business from, say, the Army, and a lot of nervousness now that, hey, this might not hold on the earnings side. And over the last 1 month, however, shares are still up 11%, but it had been going kind of parabolic, as we like to say, until the last week. So it was getting a bit too hot to handle, in my opinion, and now we are getting this pullback. So it's a number 2, as you can see here. It also has the F for value, but the valuations were through the roof. Nobody cared. It only has a B for growth, but it still has that A for momentum. It's got a C overall style score value now. So scrolling down, looking at this price to consensus, you can see the huge surge in these shares in late 2024 and here into 2025. This is a small chart, so you can barely see the pullback there. I'm going to switch over to the larger price and consensus chart. We might be able to see it a little bit better, and we do. Just right there, this pullback has been so swift and fast, it's barely showing up on these 5-year charts. But it has been a 29, almost 30% pullback now. Is this some kind of steal? Now, look at these lines on the price consensus chart on this one, on Palantir. It has already reported as well. And you can see up and to the right, pretty good spread in between. And we aren't seeing the decline here for 2025 or 2026 like we saw with Wingstop. So the analysts are probably still bullish. It does have a Zacks number 2 rank. So that is the buy. This you can see here on the price and EPS, this little 3-month chart. You can see much more clearly the sudden decline there of the 30%. But you can also see this big beat right there in the last earnings, 27% beat. But scrolling down, so revenue expected to be up 32% 2025, another 27% 2026. But Wingstop also had the same 17%, very good, solid earnings growth. But here's where the difference is. Earnings growth, 31% expected for this year and another 24% for next year. And then scrolling down, no earnings estimates cut in the last even 60 days, and not in the last week, but we are having them raised. After that last earnings report, they all got raised, 8 of them for 2025, 4 of them for 2026. And that's why we have the nice chart and the nice earnings growth, but valuation still remains stretched. On this page, you can see the PE here, 167 times. PEG ratio of 5.35. That's pretty high, even with that solid earnings growth. So this hasn't been a value stock for a long time, over a year, probably 2 years, and certainly not after it took off at the end of last year and even into this year. But it is cheaper than it was. So if you are a growth investor and you only want the growth, this could be a buying opportunity, 30% decline. A lot of investors are willing to buy on the uptick. And even if the price is sky high on a PE basis or a PEG or a price to book, any kind of valuation basis, they don't care. They're buying that growth. But we do care when we have a sell-off. And then suddenly people don't like to buy stocks when they're on sale. But this one has been reduced about 30%. So if you are a growth investor and Palantir was already on your watch list, or you already own it and maybe you want a dollar cost average, I'm liking the price and consensus setup for now, based on the facts we have in front of us now. There's always going to be these uncertainties and these fears out there, especially as it's so dependent on the military contracts. But for our information currently, as I just said, this one, the estimates are looking good. So I would put this in the deal category if you are willing and you're brave enough to step in after the 30% pullback. Still a little bit in the red here on February 25th. So maybe it has some more selling still to go. But dollar cost averaging is always your friend in these situations as well. Put a little bit in each day, and that will even out a bit. So that's Palantir Technologies, ticker PLTR. Okay, we're getting out of tech. We're going into beauty. One of the big winners the last couple of years. I did definitely call this one a beast. e.l.f. Beauty, ticker e.l.f. I recently did a bear of the day on e.l.f. because it is a Zacks number 5. Strong sell. And that bear of the day was well over a week ago. It still remains a number 5. And look at the style scores: an F for value, an F for growth. Oh no, a C for momentum, an F overall VGM score. That's never good. It's got all the worst scores you could have. So what has the stock done? Over the last month, it's down 34.6%. 6 months, it's down 57.7%. This used to be the gold standard. It would beat and it would raise and it would beat and it would raise. Stock went to all-time highs in 2024, and now it's given it all back, or a lot of it. I am looking at the price consensus and surprise. The surprise isn't the issue. It had another big beat last quarter. Oh no, this was the November one. No, then it finally missed. It did miss in February, early February, but not by much. But the real issue here with e.l.f., it's always done the beat and the raise, but this time it missed, and then it also lowered its guidance for the fiscal year. And that was only one more quarter. So I'm not liking that they saw that January was a slowdown in their business. And this is on the beauty side, and it's a little lower price points. So why is the consumer suddenly not buying, their lotions, their facial products, their mascaras, their eyeshadows and things? Why are they getting a little cautious on that? Street hasn't liked it. Stock is, really, really selling off here. Like I said, the last month down 34.6%. But look at the price consensus on this one. This looks a little more like Wingstop because they did warn, and the analysts are nervous. So fiscal 2025 is the one they warned on, but it wasn't even that bad of a warning to cause such chaos. But when you have this kind of momentum and things seem so great, any kind of warning is going to cause the sell-off with momentum stocks. And the analysts cutting both here. Let's look at the detailed earnings estimates to kind of see why it has the Zacks number 5, but you can see just scrolling down, 13 estimates down in the last 30 days for this fiscal year, which they actually warned on, but also 13 down for next year. Because if things are slowing now, why wouldn't they continue to be slow? So the analysts don't want to get behind the curve, and so they just went ahead and slashed. Let me just see how bad the slashing was. So for this year, they're down to 333 from 361 before the warning. And next year, 363 now versus 435 just 30 days ago. So that's pretty dramatic there. Still earnings growth of 4.2% for this fiscal year, which they're about to wrap up soon. Next year, just 9%. But the real problem with e.l.f. is that, while they still have this great revenue growth, this year fiscal revenue growth of 27.8%, next year 11%, that's just not good enough with the shares being as pricey as they were. Now trading at 22 times, I want to say it was up at like 50 times at one point in 2024, but it has come back down pretty dramatically. The PEG has gone up. It's now almost 5 because those estimates are actually being cut instead of rising. So even with the share price coming down, it's not enough to make it a real cheap stock. So e.l.f. Beauty kind of in that gray area. The momentum is gone. It does have some growth, but not good enough to warrant diving in. You can see here on February 25th, the shares are down still again. So everybody's just trying to get out with whatever gains they had from the last year's rally. And so I'm waiting on e.l.f. Beauty for it to bottom out. The business is still good. The brand is still solid. Still going to see nice sales growth, even if it only does the 11% for 2026. But for me, as a value investor, I'd need to get it cheaper. And for growth investors, probably not a good enough growth to get in there. The Zacks rank is reflecting all of this stuff going on. So it's got it right by being a 5 strong sell. Only 5% of all the Zacks rank stocks are number 5s. That's the worst rank you can have. So bad things or not good things are going on when you have a number 5 rank. And we can see that with e.l.f. It's just getting a little slower now. And so everybody's cashing in, and then we'll see. So that's e.l.f. Beauty, ticker e.l.f. It's pretty much a trap here. Okay, then I want to stay kind of on the retail side as well with Walmart. Walmart's been one of the hottest, dare I say it, momentum stocks out there for like the last year. And it too was hitting all-time highs going into its recent earnings report. But the stock hasn't been cheap in a long time. So where did that leave us? It left us with it needed to really crush it in that report for us to continue to really see that stock rally. And while it was a pretty solid report, it wasn't one that, the street felt they should push the stock up higher. And a lot of it is really just the consumer appears to be slowing somewhat. Walmart has been reaching out to the more prosperous consumer over recent quarters, and that has helped their business. But a lot of worries out there about the tariffs, and Walmart said they are going to be impacted by the tariffs. They're going to try to mitigate, like all the retailers will try, but their products just come in from so many different places. It's going to be nearly impossible for them to, mitigate completely, even by changing supply chains and logistics and whatnot. So that these are all the uncertainties out there. So after their earnings report, the shares were down 6.4% in the last 5 days, but they did come off a little bit more originally. They bounced back a bit. You can see here when I'm recording this on February 25th, the shares have a rebounding today, up 3.8%. So I would say this was in correction territory, down about 10% off of its highs. So that's why I wanted to include it here, because maybe that's a deal on Walmart, given its strong track record and what has been going on at Walmart over the last year or two. Over the last 6 months, it's still up 28%. So it's still holding on to a lot of its gains. So it's a Zacks rank number 3 right now. That's our hold category. 80% of all Zacks rank stocks are in the holds. It's not good. It's not bad. It's just a hold. So nothing wrong with that. A lot of big cap companies go into the hold category even after earnings, especially if the analysts are kind of mixed. If some raised, if some cut to get in line, then you get the 3. That doesn't necessarily tell us all that much. On the style scores, C for value, A for growth, D for momentum, and a B overall. So that's pretty good style scores there. And then we're scrolling down price to consensus. I haven't looked at this chart in a while, so it is interesting to see with the surprises. It did surprise again last quarter. You can see here, just like with Palantir and that sharp decline, there is a sharp little sell-off just recently on the stock that appears right at the edge of the chart there. But still not too shabby over the 5-year chart there, but off the recent highs. But look at the price of consensus. It is mostly holding up, but we are seeing a little bit of weakness here on 2025, a little downturn, and a little downturn on 2026. This is from the recent earnings report and their caution on what is happening with tariffs and the consumer and these other things. So scrolling down on the detailed estimates page, and we can kind of see the story here. I am kind of surprised it's still remaining a 3 and maybe didn't drop to a 4 after looking at what is happening with the estimate revisions, because 12 have been cut since that earnings report in the last 7 days. Only one has been raised for this next fiscal 2026. That's a lot of agreement that they needed to cut. So I am kind of surprised, again, that it's only a 3, not a 4. Next year, after this year, so that's almost, that's well into the future, 8 have been cut for the year after that. And nobody has raised in the last week since the earnings, but 8 have cut. So what does that mean? We have 265 for this fiscal year. That is down from 274 since the earnings. So not terrible cuts, but the weakness is being acknowledged, and that's what we see at that price consensus chart, just a little bit of a downturn there. Also similar for the next fiscal year, 291 versus 303. That's going to change a lot. I'm not really concerned about the next fiscal year per se, because a lot, like I said, is going to happen this year, especially with the consumer. Will we see a recession even? This is one of the biggest retailers, and they're going to get hit both on the supermarket side and on just, discretionary spending, apparel, everything else that they have. So this is a little bit of weakness, and the shares have come off a little bit. But what about the valuations now? It got as high as almost 40 times heading into this report. It's now trading with a PE of 35. That's extremely high for Walmart. And what's the growth rate, right? Well, on the sales side, we're seeing 3% for next fiscal year and 4% for the fiscal year after. But that is in their sales growth range because they're so massive. They're not really doing the double digits anymore. But even on earnings, 5.6% expected for this year, 9% for the next year, if that holds. So these are respectable, but they're respectable if I'm getting the stock at 15 times or 18 times, not at 35 times. That's more expensive than Microsoft or Apple on a PE basis. So I'm not a fan of overpaying for the retailers, even one that is executing well given the market conditions, and Walmart is. But I need more than just a 6% pullback, which is where it's at right now. I need more than even a 10% pullback. If these shares were to pull back the 20 to a bear market type of scenario, I might take a look there, but this is not so much of a deal right here. I would be on the sidelines and monitoring this one, however, and to see if I could get it cheaper. So that's Walmart, ticker WMT. Then we're going to switch back over into the tech side of things with one of the AI plays. I do own this one in Zacks Value Investor portfolio and my own personal portfolio. It's owned in a couple of other Zacks portfolios as well. Vertiv, ticker V as in Victor, R as in Robert, T as in Tom, Vertiv. It is on the AI infrastructure side. It does the build outs in the data centers, the racks, for instance. And it's global. It's not just US. So all the data centers being built out everywhere. You are going to go to Vertiv along with some other competitors, but Vertiv is one of the big guys you're going to go to. So earnings and sales have soared the last 2 years during the AI revolution, but this stock has really come down. In the last month, down 38.5%. 6 months, it's still up, but just 14% now. But the AI stocks have really come down here in February on this sell-off. So let's take a look at this one. but they all have mostly pulled back and some of them pretty extreme. So Vertiv is a number 2. That's the buy, which would lead me to think that the analysts were raising their estimates after the earnings, which were a couple of weeks ago now with Vertiv. Style scores, C for value, A for growth, B for momentum still, and an A on the VGM scores. Kind of surprised it's a C for value, but it's come down so much. I guess it's gotten more affordable. We bought pretty cheap in the value investor portfolio. The PE at the time we bought in 2023 was 17. And then it soared to around 40. But this pullback, let's see what it's at. But scrolling down, price to consensus and surprise chart, you can see here it did beat on the last quarter. And you can really tell this big sell-off here. It hit a new high, and then it was selling off even before the earnings. So this is a pretty big pullback, as I mentioned, over the last month, now down 38.5%. But look at that price of consensus up and to the right. We're not seeing much weakness, none at all for 2025, and just a little bit there in 2026 for Vertiv on the earnings. And that's, again, we have the number 2. So I'm assuming that what they said about the earnings was pretty good, and the analysts are feeling pretty good that it is going to see this kind of earnings growth. Let's look at those detailed estimates and check it out, because that's what everybody should be doing before they decide, on what they're doing with the stock, unless you're trading purely on the chart. But we want to look to see if it's a deal or a trap. Revenue for 2025 expected to be up 15% and about another 15% for 2026. This is a little higher than what they have been doing, where it's been 10 to 12%. So revenue growth has actually picked up a bit here. 2025 earnings expected to be up 25, almost 26%. And another 24% in 2026. So that's price of consensus. We can see that nice growth on the chart. Now, what have the analysts been doing? 5 or higher for 2025 in the last 30 days. 1 is lower. So someone was correcting. Maybe they got too bullish and they had a cut. And for next year, 2026, 2 are higher in the last 30 days and 2 are lower. So a little bit of a correction there. And we're at 359 for 2025. 30 days ago, it was at 358. So not that much change in what the consensus estimate really was. But I'm assuming with those 5 higher that some maybe were just being just too conservative and, raised a couple pennies or whatnot in there. So all of this looks pretty good. This is why I own Vertiv and why I like it. As long as those data centers are being built, which the DeepSeek scare put some scare into. But for now, for 2025, with the visibility that Vertiv has over the next several months, with the orders that have come in, with its partnership with NVIDIA, that's one of its partners, it is holding the course with this level of growth. So with the stock pulling back, it has gotten cheaper on a PE basis. It's now at 25 times. Like I said, at its peak, at the highs, it was trading around 40 times. So this is much cheaper, not quite as cheap as a true value stock would be for a PE, which is definitely would be under 20. But at 25, looking much more attractive. PEG ratio, just 0.9. That is a value PEG ratio. That means the stock has both value and growth. That is a rare combination to have it under the 1. Shares are still weak here in February. They're down again here in February 2025. It has not seemingly found a bottom yet. But I don't believe that this is a trap here. I do feel like this is a deal, and people should be adding to any positions and or getting in if you were interested in any of these infrastructure stocks on the data center side. They've all pulled back, like I said, and take a look, see what's happening in their earnings reports and what the companies themselves are saying about their orders, what the revenue is looking like. Now, there may be no visibility a year from now, but here in early 2025, the sell-off is providing a buying opportunity in a lot of these names. The infrastructure side has come down a lot more. And by infrastructure, I'm talking about the services side, like Vertiv, who's making the racks for the chips. And also they're building it out for someone who's building the data center and, say a Meta Platforms. They're building those big data centers down in Mississippi, I think it is. They have to hire someone to build out the interiors as well to have something to put the chips on, and then they have to hire someone to cool it. And these chips, very high powered, they overheat easily. So it's not just an air conditioning system, it's a special cooling system. There's some companies involved in that as well. They've all taken a hit here in this February sell-off. So they're all cheaper. Take a look at some of those names as well. But Vertiv, looking like a deal here, might not have bottomed yet, but it's hard to market time on these things. Vertiv has had several big pullbacks like this. So far, they have been good times to buy. So that's Vertiv, ticker VRT. And again, I own it in my own personal portfolio and in Zacks Value Investor portfolio. So these are an interesting group of stocks. It's really going to depend on what the earnings outlook looks like going forward for this year and next year. That will change as we go throughout the year, obviously. But for now, a couple of these look a little more trappy than deals, even with the sell-offs, and some are deals and the earnings are looking pretty good. So you might want to keep some of those on your watch list. Some may still have some valuation issues as far as I'm concerned as a value investor, but some still have that real strong growth component. So if you're a growth investor, you might want to keep some of these, again, on your watch list because they look very intriguing after these pullbacks. So let me recap the stock tickers in this episode. We had Wingstop. That's looking a little bit like a trap here, ticker WING. We had Palantir. It sold off on these worries about its military contracts, but so far the earnings looks intact. Ticker P as in Paul, L as in Larry, T as in Tom, R as in Robert. We had e.l.f. Beauty, which did issue a warning in its last earnings where it saw a slowdown in January. So some of those estimates coming down. Ticker E.l. as in Larry, F as in Frank, E.l.f. We had Walmart, also a little bit of uncertainty with the tariffs and the consumer over there, but still a pretty solid quarter. But is it cheap enough? Ticker W as in Wayne, M as in Mary, T, WMT. And then we wrapped it up with Vertiv, which I just talked about. Ticker V as in Victor, R as in Robert, T as in Tom. And as always, you can subscribe to get the audio versions of these podcasts on Apple. We're on Spotify. We're on Amazon Music. But you can get the video versions, as you know, on YouTube. Go over and subscribe. I know many of you are. Check out the Gold podcast as well. You get some good information in there. You might want to check it out. But subscribe so you don't miss a single podcast or any of our videos, including the top stock picks of the week, as well as the Earnings All-Stars videos and a bunch of other things. But be sure to subscribe, and I'll see you again next week with some more stocks.